TransUnion, ticker TRU on the NYSE. Founded in 1968 in Chicago, originally as a railcar leasing holding company, TransUnion pivoted early into consumer credit data and has spent over 50 years building one of the three indispensable credit infrastructure companies in the world.
Today, TransUnion holds credit and identity data on 1 billion consumers across 30-plus countries. Every time a U.S. lender pulls a credit file, mortgage, auto loan, credit card, there is roughly a 1 in 3 chance that file comes from TransUnion.
After going private in a Goldman Sachs PE buyout in 2012, TransUnion modernized its technology platform and returned to public markets in 2015 at a $4.4 billion valuation. Growth through acquisitions followed, Call Credit in the UK and Neustar in digital identity.
The U.S. credit bureau oligopoly is one of the most durable structural moats in American finance. 3 companies, Equifax, Experian, and TransUnion, control the data infrastructure every major lender depends on. That structure is recognized and regulated, not accidental.
TransUnion's revenue splits across 3 segments: U.S. markets at 55%, international at 31%, and consumer interactive at 14%. Total revenue is $4.2 billion, and the international segment is the fastest growing piece.
The unit economics are exceptional for an information business. Adjusted EBITDA margin runs at 37.8%. Free cash flow conversion is 85%. Organic revenue growth of 8.2% demonstrates the pricing power and network effects of the data franchise.
70% of revenue is subscription or high retention contract-based. Lenders don't stop pulling credit files. They need them to make every loan decision. That structural dependency creates revenue visibility that almost no other business model achieves.
On the competitive radar, TransUnion scores highest in international growth. The 45% international revenue mix is the strongest diversification among the big 3 bureaus. FICO leads on analytics depth and legal risk profile. Experian leads on international expansion maturity.
The fraud detection, identity verification, and risk analytics products layered above the raw credit data embed TransUnion deeper into lender and fintech workflows, raising switching costs far beyond the base credit report relationship.
TransUnion's global network spans more than 65,000 U.S. lender customers, operations in 30-plus countries, and data on 1 billion consumers. Infrastructure that simply cannot be rebuilt from scratch in any competitive timeframe.
Chris Cartwright has been president and CEO since 2020. A Wharton MBA who built his career at Dun & Bradstreet before joining TransUnion in 2013, he ran the U.S. market segment and served as president before stepping into the chief executive role.
Cartwright's focus since taking the CEO chair has been international expansion, analytics product deepening, and navigating the litigation environment, 3 parallel mandates that require capital allocation discipline the company has broadly delivered.
The international opportunity is the long-term growth engine. In markets like India, Colombia, and South Africa, credit bureau infrastructure is less mature. TransUnion enters as the premium provider, replicating the U.S. bureau model in economies where the middle class is still building its credit profile.
Net leverage of 3.1 times reflects the Neustar acquisition investment. The free cash flow profile, 85% conversion at nearly 38% EBITDA margins, gives management both the flexibility to delever and the capacity to invest in new analytics products simultaneously.
TransUnion is one of 3 companies in the world with a pipeline into every major lender's credit decision. 57 years of data on 1 billion people is not rebuilt from scratch.
The data breach litigation is the binary. A large settlement is already anticipated, but a systemic liability finding rewrites the risk profile entirely. We dig into the numbers every quarter. Subscribe so you never miss a Charged Alpha deep dive.
TransUnion, ticker TRU. Q1 2026 earnings are in, and here is the paradox. The company posted a GAAP EPS beat of 86%. The biggest headline beat you will see this earnings season, and the stock fell 2%. The market saw through the number. The question is whether you should too.
TransUnion traces its roots to 1968 as a railroad freight car leasing business that pivoted into consumer credit data. Today, it is one of 3 credit bureaus powering the global financial system, and Q1 2026 was its most talked about quarter in years, for reasons that cut both ways.
The headline, EPS of $2.06 versus the $1.11 estimate, an 85.6% beat. Revenue of $1.246 billion versus $1.21 billion expected, a 3% beat and 13.7% year-over-year growth. Both metrics beat, stock down 2%. That tells you something.
Here's what the market figured out in real time. That $2.06 EPS is not operating earnings. It is GAAP earnings, inflated by a $350 million one-time gain that ran through the other income line. Strip that out, and core operating income was $245 million, actually lower than the $254 million TransUnion earned in Q1 2025.
The operating cash flow confirms the read. Net income was $397 million. Operating cash flow was $84 million. That gap between reported income and actual cash generation is the fingerprint of non-recurring, non-cash items. The paper gain is real on the income statement. The cash is not there.
Let us walk through the numbers precisely. Revenue of $1.246 billion, up from $1.096 billion in Q1 2025. That is $150 million of incremental revenue year over year, a 13.7% organic acceleration. That is the real story of this quarter.
On the income statement waterfall, revenue $1.246 billion, cost of goods sold $520 million, gross profit $726 million, a gross margin of 58.3%. That is a strong gross margin for a data business, reflecting the high fixed cost nature of credit bureau infrastructure.
Operating expenses below gross profit. SG&A of $329 million, other operating costs of $152 million. Total operating income, $245 million. Operating margin of 19.7%.
For context, in Q1 2025, TransUnion had operating income of approximately $254 million on revenue of $1.096 billion. In Q1 2026, despite growing revenue 13.7%, operating income declined. That is margin compression, and it is the critical detail analysts will be focused on.
The one-time gain sits in other income, $350 million. Add that to operating income of $245, subtract interest expense of $98 million and taxes of $100 million, and you arrive at net income of $397 million. EPS of $2.06. That is the arithmetic behind the headline.
Revenue by segment. U.S. markets generated $686 million, representing 55% of the total. International contributed $324 million, 26%. Consumer Interactive, the direct-to-consumer credit monitoring business, added $236 million, 19%.
The revenue growth story is primarily a U.S. financial services and international story. U.S. lending volumes have picked back up as mortgage refinancing activity ticked higher, and auto lending normalized after the rate shock of 2023 and 2024. International is growing in emerging markets where credit infrastructure is still being built.
Fraud and Identity Analytics, the fastest-growing subsegment within both U.S. markets and international, is growing at double-digit rates. This is the higher-margin mix shift the market wants to see. Every percentage point that fraud and identity grows as a share of revenue improves TransUnion's long-term margin profile.
Valuation context. TRU is trading at $69.97, down 2.1% on earnings day. The 52-week range runs from $65 to $99.39. The stock sits just above its 52-week low despite the earnings beat.
Market cap of $13.4 billion. On a trailing GAAP basis, the PE multiple is 29.9 times. But as we have established, that GAAP number includes a 351-time gain. Stripping that out, the underlying earnings multiple is substantially higher.
Forward PE of 18.2 times on the FY 2026 consensus estimate looks more reasonable. EV to EBITDA of 12.5 times reflects both the operating earnings power and the debt load. Price to sales of 2.9 times is below where premium data analytics companies historically trade.
The balance sheet is the key variable in the valuation discussion. Total debt of $5.6 billion against cash of $733 million gives a net debt position of $4.875 billion. Net debt to EBITDA sits at 3.3 times, elevated for a company navigating margin pressure.
Analyst Consensus is a buy rating with an average price target of $94.75. That implies 35.4% upside from current levels. The high target is $111. The low is $80. The gap between the consensus target and the current price is the opportunity if the earnings quality can improve.
The forward EPS projection for Q2 2026 is $1.15, down sharply from Q1's headline $2.06. That sequential compression reflects both the absence of the one-time Q1 gain and typical seasonal patterns in financial services data demand.
For the full fiscal year 2026, the consensus estimate is $4.60 per share. At $69.97, that is a forward PE of roughly 15 times on full-year estimates, a significant discount to where TransUnion has historically traded and to where comparables sit today.
Revenue consensus for FY 2026 is $5.1 billion. That implies an annualized growth rate of roughly 11% from the trailing 12-month revenue of $4.576 billion. If TransUnion can sustain this pace without operating margin deterioration, the re-rating math becomes compelling.
The long-term earnings growth consensus sits at 15% annually. Credit bureau data businesses have historically been able to compound earnings faster than revenue as operating leverage kicks in at scale. The question for TransUnion is whether the Neustar integration and debt burden are preventing that leverage from materializing.
Behind the revenue beat, what drove 13.7% year-over-year growth? 3 factors. First, U.S. financial services demand rebounded as mortgage application volumes recovered and consumer lenders re-engaged. Credit inquiry volumes are the lifeblood of a credit bureau, and Q1 saw genuine recovery there.
Second, fraud and identity analytics continued its high-growth trajectory. Businesses across banking, insurance, and fintech are spending aggressively on identity verification and synthetic fraud detection. This is a structural demand shift, not cyclical, and TransUnion's Neustar assets give it a differentiated identity graph.
Third, international markets contributed meaningful growth. The company is investing in credit infrastructure in India, Colombia, and South Africa, markets where the concept of a consumer credit score is still relatively new. Capturing that market as it develops creates long-duration revenue streams with early mover advantages.
Consumer Interactive, the direct-to-consumer credit monitoring segment, held steady at around $236 million. This segment benefits from subscription revenue from consumers checking their own credit, but faces headwinds as free credit monitoring tools from banks and fintechs have proliferated.
The operating margin story is where the pressure is most visible. Q1 2026 operating margin of 19.7% compares to approximately 23.2% in Q1 2025. That is 3.5 points of margin compression on 13% more revenue. Revenue is growing, margins are not following.
The compression has 2 sources. First, cost of goods sold grew faster than revenue as TransUnion added data partnerships, technology infrastructure, and headcount to support international expansion. Second, interest expense of $98 million is a recurring drag from the $5.6 billion debt load on the balance sheet.
The cash flow statement is the most important signal of underlying business health. Operating cash flow of $84 million in Q1, capital expenditures of $65 million, free cash flow of just $19 million. For a company with $13.4 billion in market cap, $19 million in quarterly free cash flow is a concern investors are right to flag.
That $84 million in operating cash flow versus $397 in net income tells the complete story. The $350 one-time gain added to income but did not produce cash. The actual cash-generating power of the business in Q1 was meaningfully below the GAAP headline. Cash is the honest currency of earnings quality.
Balance sheet summary. Total assets of $12.0 billion, Total equity of $4.754 billion. Current ratio of 1.2, adequate but not comfortable. No dividends, no buybacks. Every dollar of cash generation is effectively earmarked for debt service before any return to shareholders is possible.
The bull case for TransUnion is not built on Q1's GAAP EPS number. It is built on the revenue acceleration. 13.7% year-over-year revenue growth is real. It came from genuine volume growth in financial services and structural expansion in fraud and identity. That is the kind of growth that eventually translates into earnings.
The data moat is real. TransUnion is one of 3 U.S. credit bureaus with statutory rights to collect and monetize consumer credit data. That oligopoly structure has existed for decades, is protected by regulation, and is virtually impossible to replicate. You cannot build a 4th credit bureau. The incumbents own the castle.
The fraud and identity vertical growing faster than the core credit business is the most important secular trend in the TransUnion story. Enterprise identity verification is a critical infrastructure need. Every bank, insurer, and digital lender needs it. This is a higher margin, faster growing business embedded within a mature credit bureau infrastructure.
The analyst setup supports a recovery thesis. 20 of 26 covering analysts rate the stock buy. The average target of 94.75 is 35% above current levels. The high target is 111. These are not speculative price targets. They are estimates from analysts covering the business week to week.
CEO Cartwright signaled conviction in the business by purchasing 5,000 shares at approximately $70 in January 2026, near the 52-week low. An insider buying near the 52-week low is a qualitative signal worth noting, especially when the CEO has a decade of operational context in the company.
The bear case starts with the debt, $5.6 billion in total debt against $733 million in cash. Net debt of $4.875 billion. Net debt to EBITDA of 3.3 times. This balance sheet is constrained. TransUnion does not have the balance sheet flexibility to make mistakes.
If the credit cycle weakens, if banks tighten lending standards, if mortgage applications fall, if consumer delinquencies spike and lenders reduce inquiry volumes, TransUnion's revenue is directly impacted. The business is cyclically exposed to the very same financial conditions it helps measure. That beta shows up. TRU's beta is 1.71.
Operating margin compression is the quiet alarm. 19.7% in Q1 2026 versus 23.2% in Q1 2025. Revenue grew 13% and operating income still declined. That means costs are growing faster than revenue. If that pattern continues, TransUnion is on a treadmill, growing revenue, not growing profit.
The litigation overhang is real, even if the specifics belong in the company chapter context. The core point for this quarterly discussion is that legal uncertainty creates an unpredictable line item that can absorb any free cash flow the business generates. At $19 million in quarterly FCF, there is no cushion for a material legal settlement.
The rivals are not standing still. Equifax has invested heavily in its cloud-based EFX cloud migration and is winning new analytics contracts. Experian is expanding its U.S. footprint and deepening its fraud and identity offerings. Both are larger businesses with more diversified revenue. The competition for enterprise data contracts is intensifying, not softening.
And the GAAP EPS distortion creates a practical problem for investors. If you are screening TransUnion on a PE basis using Q1's 206 EPS, the company looks cheap. But that EPS number is one-time inflated. The underlying earnings power based on operating income and cash flow is substantially lower and should be the basis for any multiple analysis.
Peer group comparison reveals just how cheaply TransUnion is trading relative to data and analytics companies. Start with the closest peers, Equifax and Experian. Equifax trades at 17.2 times EV to EBITDA and 24.8 times forward earnings. TransUnion at 12.5 times EBITDA and 18.2 times forward is a meaningful discount.
Experian, the global leader by revenue at $8.1 billion, commands an EV to EBITDA multiple of 18.5 times. Its gross margin of 57.8% is nearly identical to TransUnion's 58.3%, yet Experian trades at a 60% premium on EBITDA. Part of that gap reflects Experian's lower debt burden.
Moving up the quality spectrum, Verisk Analytics trades at 25.4 times EV to EBITDA with a 66.4% gross margin. Verisk is a specialized analytics business with lower cyclical exposure and higher margin quality, hence the premium. It is a useful benchmark for where TransUnion could trade if it executes on margin improvement.
Moody's Corporation, another data and analytics franchise, trades at 22.8 times EBITDA with a 69.3% gross margin. The pattern is consistent. Companies with higher margin quality and lower leverage trade at significant premiums to TransUnion.
The conclusion from the peer comparison is clear. TransUnion's discount is not purely a value opportunity. It reflects a genuine discount for margin pressure and debt. Closing that discount requires either paying down debt to reduce interest burden or demonstrating sustained margin improvement. Neither happened in Q1 2026. Revenue grew, everything else needed work.
Options market positioning going into earnings was mixed. The put-call ratio of 0.85 was modestly elevated. More puts than the neutral level, reflecting the market's skepticism about earnings quality even before the print. Call spread activity with a June 75 to 85 bull spread at 3,400 contracts suggested some institutional positioning for a recovery.
Protective puts on the $65 strike, 2,800 contracts, were in place as a hedge against the litigation risk scenario. The options market was pricing both a positive outcome and a tail risk scenario simultaneously. That is consistent with a stock trading near its 52-week low with an uncertain earnings narrative.
Bottom line on TransUnion, the 86% GAAP EPS beat is a headline number that does not reflect the underlying business reality. Operating income declined year over year. Free cash flow was $19 million. The $350 million other income gain is real accounting but does not represent recurring earnings power.
The genuine positives are real. Revenue growth of 13.7% year over year is accelerating. Fraud and identity analytics is growing faster than core credit. International expansion is building durable revenue streams. The data moat is intact. A 20 by Analyst Consensus sees 35% upside. These are not imaginary positives.
But the path from $69 to the $94 consensus target requires the company to demonstrate actual earnings recovery, not paper gains. That means operating margin needs to return toward 23 to 25%. That means free cash flow needs to be measured in hundreds of millions, not single digits.
The $5.6 billion debt load is the constraint around which everything else is built. Until TransUnion either pays down meaningful debt or grows EBITDA fast enough to reduce the 3.3 times leverage ratio, the balance sheet limits the upside and magnifies any downside. That was true before Q1. It remains true after Q1.
If you are a long-term investor, this quarter reinforced one thing. The revenue trend is real. The company is growing its top line at 13% on a business that was stuck in the low single digits. If the margin compression story resolves over the next 2 to 4 quarters, TransUnion re-rates meaningfully. If it does not, the debt becomes a more serious problem.
TransUnion Q1 2026. The best headline EPS beat you cannot fully trust, the best revenue quarter in years, and a stock that correctly priced both. Read the cash flow. Watch the operating margins. The thesis lives or dies on whether revenue growth eventually flows through to real cash earnings.
This content is for informational and entertainment purposes only and does not constitute financial advice. All investments carry risk, including the potential loss of principal. Past performance is not indicative of future results. Always consult a licensed financial advisor before making investment decisions.
Charged Alpha, powered by data, driven by insight. We will see you on the next one.
Ooh, we do! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.